Welcome back to the deep dive. We're here to cut through the noise and really get to the heart of what's happening with key companies.
That's right. And today we're looking at a fascinating one, Five Below.
Ticker symbol FYE. The big question we're asking is, how is this retailer known for its, bargain finds, not just surviving, but actually thriving right now? It feels like they're almost redefining the discount space.
They really are. And their latest results, Q2 fiscal 2025, give us a lot to unpack.
Exactly. So our mission today is to dig into those results, understand what's driving this pretty impressive performance, and see what the outlook is. We want to give you the key knowledge, fast and clear.
And you use the word impressive, and it really fits. This wasn't just a good quarter for Five Below. It was, frankly, a standout.
Beating expectations significantly.
Across the board, yeah. The headline numbers themselves tell a story of, acceleration.
Okay, so let's start with that snapshot. Revenue first.
Yep. Reported $1,026.8 million. That's up a huge 23.7% year over year.
Wow, and over $1 billion. That's significant, isn't it? First time they've hit that outside of a Q4.
Exactly. It's their first non-holiday quarter cracking the billion-dollar mark. Shows real scale growth.
Okay, top line strong. What about the bottom line? Earnings.
Also very strong. Adjusted EPS, that's earnings per share, hit $0.81, and that beat estimates by something like 31%. Pretty substantial beat.
Huge beat. And the underlying health indicator. Comp sales.
Comp sales, comparable store sales, looking at existing stores, grew an incredible 12.4%.
12.4%. That's a massive number in retail today.
It really is. You don't see that often.
So how did the market take all this? Enthusiasm.
Oh, yeah. Notable enthusiasm. It wasn't just a small beat, like you said. The market reaction showed real confidence, I think, both in the results and the outlook.
Validated the positive sentiment that was already kind of building.
And maybe even exceeded it. This quarter felt like a confirmation, a big one.
Okay, so strong results, positive reaction. But how do they do it? Let's get into the deep dive, the drivers.
Right. Let's unpack those pivotal financials. That 12.4% comp growth. Where did it come from?
Yeah. Was it more people or people spending more? Or both?
Primarily driven by traffic. Transactions were up 8.7%, so significantly more customers coming in and buying.
Okay, that's a strong sign. More foot traffic.
Definitely. But they also got a lift from the average ticket size, or what they sometimes call AUR, average unit retail. That was up 3.4%.
So both levers working. More people, and those people spending, on average, a bit more per item or per trip.
Exactly. It's broad-based strength, not just relying on one thing.
And that feels more sustainable, doesn't it? Unlike, riding a single hot trend.
Much more sustainable. It suggests a more fundamental improvement in how customers are engaging with the stores.
Okay, selling more is great, but did they make more money on each sale? What about profitability, margins?
Good question, especially with all the pressures out there like tariffs. And yes, they did expand margins.
Oh, interesting. How much?
Adjusted gross margin went up by 70 basis points. That's 0.7%, bringing it to 33.4%.
What?
And adjusted operating margin increased even more by 90 basis points to 5.4%.
So despite headwinds, they're leveraging those higher sales into better profitability. That speaks to good management, good operational control.
It really does. Shows effective cost management and getting leverage on their fixed costs as sales grow. They're not just growing, they're growing more profitably.
That's the goal, right?
Yeah.
Profitable growth.
Yeah.
What about their financial foundation? Cash, debt.
Super solid. They ended the quarter with about $670 million in cash equivalents, and investments.
And debt.
Zero debt. None.
Wow. Okay, so that gives them a ton of flexibility.
Huge financial flexibility. They can fund growth, handle bumps in the road, whatever they need without relying on external financing. It's a, frankly, enviable position.
So with that flexibility, what are they doing? Are they hitting the brakes or stepping on the gas with expansion?
Definitely stepping on the gas. They're continuing that aggressive store growth. Added 32 net new stores in Q2.
32. Across how many states?
21 states. Bringing their total store count up to all 1,858. That's an 11.5% increase in stores year over year.
And are these new stores pulling their weight? You hear sometimes about rapid expansion diluting performance.
Seems like they're managing it well. New store productivity is hitting their targets, reportedly in the mid-80% range.
Mid-80s. That's considered pretty good, right?
Yeah, that demonstrates a successful unit expansion strategy. They're not just planting flags, they're opening stores that perform well relatively quickly.
Okay, so strong financials, profitable growth, successful store rollout. What's the secret sauce here? What are the strategic wins they're pointing to?
They talked about a few key things. One is constantly curating relevant, newness,
Wow.
keeping the assortment fresh and exciting.
That treasure hunt feel.
Exactly. And they also simplified pricing, moved mostly to whole dollar price points, $1, $3, $3, $5 for most things outside of candy.
Makes it easier for the customer, I guess. And maybe for operations, too.
Both. Easier shopping experience, more efficient at checkout and stocking. And interestingly, they said customers seem to be accepting these new whole price points well, even with some prices moving up slightly, less resistance than they expected.
That's interesting. So the value perception holds.
It seems so. They also mentioned significant improvements in just basic blocking and tackling, better in-stocks, better product flow through the network. That helps sales directly.
Can't sell it if it isn't there.
Pretty much. And they've got this new mantra, apparently. The customer is our boss.
What does that mean in practice?
Sounds like a renewed, intense focus on getting everything right for the customer, the products, having enough staff in stores, the service levels, really optimizing the whole experience.
So it's not just one thing. It's product, pricing, operations, customer focus.
Right. And critically, the growth isn't tied to just one massive trend this time, like maybe it was in the past with, say, fidget spinners or something.
Yeah, I remember those days.
Now, the strength is broad-based. Across 6 of their 8 main product categories, or worlds, as they call them.
6 out of 8. That sounds much healthier.
Much healthier, more sustainable. They did mention licensed collaborations doing well, like a Stitch Surf Shop theme, but it's part of a broader strength, not the only driver.
And what about 5 Beyond? The items over $5. How does that fit in now? I know they've tweaked that strategy.
Yeah, it's evolved. Instead of a separate section, those items are now integrated in line within the relevant categories.
So like a $7 tech gadget would be with the other tech stuff.
Exactly. The idea is still offering that wow value, but at slightly higher price points. Think $6, $7 where it makes sense, enhancing the treasure hunt. They seem to be avoiding big jumps to $15 or $20, keeping it closer to the core value idea.
Feels more natural that way, maybe. Less jarring than a completely separate zone.
Potentially, yeah. And they're backing all this up with marketing. They mentioned effective campaigns using creator content.
Leveraging the social media influencers and the like.
Seems so. Connecting digitally with younger customers and also millennial moms, driving both new and repeat visits. Using social for those big curtain-up moments like back to school or holidays.
Makes sense. Okay, let's talk about challenges. Tariffs have been a big cloud over retail. How are they navigating that?
They acknowledged the ever-changing tariff environment, but they seem to be handling it pretty effectively.
How so? What's the impact looking like now?
Well, for Q3, the expected gross margin hit from tariffs has actually improved. They now see it as about 160 basis point headwind.
Oh, okay, 1.6%. What was it before?
They previously guided closer to 225 basis points or 2.25%. So a decent improvement.
And why the improvement? Better pricing power, cost cutting.
A mix of things. Better than expected price elasticity, meaning customers absorbed price adjustments better than feared. Also a favorable sales mix, and yeah, some cost mitigation efforts. They've built sort of a toolkit to manage tariffs.
Toolkit, like what?
Strategic price adjustments, tweaking the assortment, and actively diversifying where they source products from, moving away from over-reliance on any one country.
Shows agility. What about shrink? That's another big retail headache. Inventory loss, theft.
Yeah, it's a major focus for them right now. They're in the middle of doing significant physical inventory counts across their stores to get a really accurate picture.
So we don't have the full story yet.
Not yet. They said they'll share the results and their specific strategies to combat shrink on the Q3 call. Definitely something investors will be watching closely.
Absolutely. Got to protect those profits. And related to tariffs and product availability sourcing, are they changing anything there?
They're being proactive, accelerating when they take ownership of goods to get more control, and diversifying their sourcing base more. That includes actually increasing domestic sourcing.
Oh, bringing some production closer to home.
Seems like it. All part of managing global trade risks and ensuring products are on the shelves.
Okay, so they're managing challenges, executing strategically. What does this mean for the outlook? Did they raise guidance?
They did, significantly. For the full fiscal year 2025, they raised the sales forecast to $4.52 billion.
And earnings.
Adjusted EPS guidance lifted to $4.76, $5.16 for the full year.
Big bumps. And comp sales for the year.
Now expecting 5% to 7% comparable sales growth for the full year, up from previous forecasts, Shows a lot of confidence.
Definitely. What about the current quarter, Q3? What's the expectation there?
For Q3, they're projecting sales between $950 and $970 million. Comp sales also expected to be in that 5-7% growth range.
Still strong growth. And EPS for Q3?
Expected between $1.12 and 24 cents adjusted. Now, that range does factor in those remaining tariff margin headwinds we talked about.
Okay.
And also higher SG&A expenses, that's selling, general, and administrative costs.
Why higher SG&A?
Partly due to higher incentive compensation because performance is strong, and also investments in store labor, specifically for those big inventory counts they're doing to tackle shrink.
Got it. Investing to solve a problem. Makes sense. So the long-term story here, it feels like it's shifting.
It is. They explicitly talked about moving the narrative from recovery to profitable scale-up.
Profitable scale-up, I like that.
Yeah, it signals confidence and consistent execution, continued store growth, evolving the merchandise, especially highlighting opportunities in like personal celebrations and holidays, integrating Five Beyond effectively, and using that supply chain agility. It's a clear roadmap.
So stepping back, what does this tell us in the broader investor context about retail overall?
Well, it certainly highlights resilience in the U.S. retail sector, especially for value-focused players. Five Below is outperforming on both traffic and ticket size, which is pretty compelling.
It suggests consumers are still spending, but maybe being more careful, looking for value.
Exactly. Value and perhaps experience. Five Below's model is very much brick-and-mortar, kid-centric, that in-store treasure hunt. That differentiates them quite a bit from pure e-commerce.
And that physical presence could be an advantage, especially with potential changes to import rules, right? Like the de minimis threshold.
Potentially, yeah. If rules change affecting platforms that rely heavily on cheap, direct from overseas shipping, it could level the playing field somewhat for domestic retailers like Five Below. It highlights the value of their physical network.
So this strong Q2 and the raised guidance, it really feels like an inflection point, moving past just recovery.
Absolutely. From recovery to that profitable scale up. And it's built on actually managing the big macro issues like tariffs effectively.
And analysts are noticing.
Oh yeah, sell-side reaction has been very positive. Upgrades, higher price targets, reinforces that bullish sentiment.
So looking ahead, what are investors watching for next? Q3, holidays.
Definitely continued comp strength in Q3, execution through the crucial holiday season, and updates on shrink, what they found and what they're doing, plus any more clarity on tariffs. Disciplined execution is key.
Lots to track. Okay, let's shift gears a bit. Time for that segment where we explore some thought experiments. Maybe slightly out there ideas.
Right, and just to be absolutely clear before we dive in, this is purely for entertainment and analytical discussion. We are not financial advisors. Nothing here is financial advice. Investing carries risk. Always do your own homework.
Couldn't have said it better myself. Okay, disclaimer done. The big idea we were kicking around, we're calling it Five Below's Untapped Celebration Market Takeover.
Intriguing. What's the thinking?
Well, they specifically mentioned seeing more business opportunity in terms of personal celebrations as well as holiday celebrations, inclusive of party.
Right, they did call that out.
Combine that with their proven agility, taking new trends from zero to hero, quickly the way they've integrated Five Beyond now, and just their strong store economics.
Yeah.
It feels like there's huge potential beyond their current core.
So you're thinking they could become the go-to place for like birthday parties, seasonal events, decorations, maybe even small gifts for those occasions?
Exactly. The undisputed, value-driven destination for all celebration needs. Leveraging that physical footprint, that treasure hunt appeal. Imagine grabbing party favors, balloons, wrapping paper, maybe even a cool $7 gift, all in one quick, fun trip.
Okay, I can see the potential. It fits their model. So if you believe the market might still be underestimating that specific growth angle, how might someone hypothetically position for it?
Right. So this is the outrageous but plausible part. Given the strong transaction growth, the positive reaction, the shift to profitable scale-up, if you think the market still undervalues the long-term compounding power, especially from capturing this celebration market.
You'd be looking for a longer-term, perhaps more leveraged way to play it than just owning the stock.
Maybe. Again, purely hypothetical, highly speculative. But one thought experiment could involve longer-dated call options.
Okay, explain that. Buying calls. Betting the price goes up? Longer-dated means
options expiring further out, maybe 12, even 18 months. And specifically, out-of-the-money calls.
Meaning the strike price, the price the option lets you buy the stock at, is significantly above the current stock price, like 20-25% higher.
Exactly. It's a bet that not only will the stock go up, but it will go up substantially over that longer time frame, enough to make those higher strike price options valuable.
So the outrageous part is believing these new initiatives, like the celebration focus, could drive growth so much faster or higher than current analysts expect that it pushes the stock well past those higher targets.
That's the essence of the thought experiment.
Wow.
It's betting on that profitable scale-up narrative really accelerating into FY26, fueled by things like dominating the value celebration market and catching the market by surprise. High risk, obviously.
Very high risk. Options are complex, but an interesting thought experiment based on the strategic direction they highlighted.
Okay, let's bring it back home. To recap this quarter for Five Below, a really powerful message came through.
Absolutely. Strong financials, fantastic comp sales growth, driven by actual customer traffic, which is key.
Expanding margins, even with tariff pressures, and a very clear, actionable strategy for what they're calling profitable scale-up.
They seem strategically well-positioned. Lots of plans for the holidays, clear roadmap for growing stores and evolving what they sell.
Which leaves us with a final thought for you, the listener, to mull over. Will Five Below's focus on the customer is our boss, combined with their knack for jumping on trends and evolving their model? Will it truly solidify them as the go-to place for all those kid and kid at heart needs, even pushing well beyond that $5 price point more consistently?
That's definitely something fascinating to watch unfold.
Indeed it is. Thanks for joining us for this deep dive.
And remember, everything we discussed today is purely for informational purposes. It is definitely not financial advice. Please always do your own research. Until next time, stay informed.